Welcome to this week's series of Green Connect. Today we're going to talk a little bit about economy and the markets, but more specifically, the events that transpired with the consumer price index or inflationary measures and the producer price index, another inflationary measure, data that was released last week that is showcasing kind of a positive trend or so, right? Inflation has been this dominant topic over the past 18 to 24 months, and we are now starting to see those very much delayed effects of the Fed's interest rate policy, right? The tightest Fed in the past 40 years. Alicia, it was interesting to see what happened with the consumer price index. What happened with the producer price index, right? The prices that the producers have to pay for goods and services.
So with the consumer price index, we saw it come in lower than expectations, but with the producer prices, we actually saw some deflationary pressures within those within that PPI index.
Yeah.
So that is very positive for the market, because that can introduce lower interest rates from the Fed down the road.
Yeah, and if producers are paying lower prices, right, presumably over that 3, 4, 5 month lag, there's going to be that inflection point where that gets transferred over to consumers in lower prices. It is important to note, we mentioned this in the past numerous times actually, that the previous peaks in inflation where the attribution to that, right, the reason for that, a large function of it was shelter costs. And shelter costs in this case translate to rental prices, right? If I'm renting an apartment, those costs are going higher and higher each month. The reality is the vast majority of Americans, roughly 67%, 68% of them, own their homes, and over 90% are locked into a fixed interest rate pre the Federal Reserve's tightening cycle. Meaning, although shelter costs have spiked inflation, the impact to most Americans hasn't been as widespread on that. So obviously, inflation is trending in the right direction. So that means 3 interest rate cuts this year, 4, 5, 6. What's the trend look like for that?
So that's what the market anticipated coming into the year, right? They anticipated 6 or 7 interest rate cuts. What we're seeing is now that the market is anticipating around 2 interest rate cuts, but the Fed came out last week and said they actually only anticipate 1. So significantly less interest rate cuts priced into the market right now. And what that did was it made rates fall last week because of the favorable CPI figures. Yep. But what we're seeing is that rates are going to stay higher for longer. And because the Fed is so data dependent, we're seeing a lot of volatility within the interest rate market. So last week alone, we saw yields fall 20 basis points on the 10-year. Wow. So very significant. We think that introduces a lot of risk within fixed income markets currently.
Yeah, and even that one Fed rate cut that's baked in right now, at least that was what was alluded to by Chair Jerome Powell, they are still very data dependent on that, right? This is still June timeframe that we're talking about here. So for that one rate cut by year end, a lot of things have to go the right way, which is going to change the narrative at some point on, oh, why is the Fed actually cutting interest rates, right? It's going to turn the narrative back on the economy, back on growth, back on consumers. So it's one of those things where, buyer beware or investor beware what you wish for kind of a concept, because yes, we all want lower interest rates. The reasoning for that may be interesting. You brought up a good point on the fact that there's been more volatility in the fixed income market than in the equity market here of recent. As we're allocated between large caps, mid caps, and small caps, walk us through some of those differentials over the past couple of weeks in terms of performance. What's actually been an interesting green flag, not a red flag, within that data set?
So when we look year to date, what we see is significantly that large caps are outperforming small and mid caps. And that transpired last year as well. But when we look at recent performance, what we're seeing is that we're seeing some better performance within that mid and small cap space. And at Credent, we diversify across all market caps. We have large, mid, and small. And by having that diversification, if we see that broadening out and we see that performance continue within mid and small, our portfolios stand to benefit really well.
It's really important to note, right? All the diversification front, those small and mid-cap companies, meaning smaller size companies that are publicly traded, are still notably underperforming the likes of like the S&P 500 and the such. And one of the things we like to look into pretty adamantly is the concentration of the return profile of an index. In the year to date, the S&P 500, largely those top 10 names have attributed for nearly 75 to close to 80% of the return profile, right? So diversification from the U.S. equity market standpoint has not actually benefited most investors. The events that have transpired over the past couple of weeks are certainly looking like that may be a benefit here as we head into year end.